to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mancell, founder of Mancell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on the Solactive Australia 200 Total Return Index, which some investors may know is tracked by Betashares A200 ETF. It's 200 of the largest companies listed on the ASX, and the Betashares ETF is becoming a very popular ETF in Australia. In 2024, it was the fourth in net fund flows, behind BAS at number 1, IVV at number 2, and VGS at 3. The index is worth talking about, but there's also not a lot of data to look at because Solactive is a relatively new index provider from Germany. They started in 2007, while the inception of this index was in 2010. So we'll come at this one from a little bit of a different angle. Your Investment Philosophy, a book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make us tap the sign. These are simple concepts. We'd like investors to better understand risk so they can make informed decisions. Periodic performance, as noted, not a lot of data, so we've included similar ASX indices for comparison over the time frame. Obviously, this comes down to investor preference, and it's a bit of a fight over basis points. And because the ETFs that track the ASX 200 and the ASX 300 and the Solactive Australia 200 do attract a lot of money. VAS, IOS, STW, A200, and those are the ETFs, and they all have very low costs. Now, Peter, there are some big differences in performance. Not to say big differences, but there are differences in performance between the Solactive 200 and the ASX 200, maybe noise, but there's a bigger difference when you look at the ASX 300. So I've included something down the bottom, which is the small ordinaries, and the small ordinaries is the ASX 300 minus the top 100 companies, which might indicate why the ASX 300 is lagging over this time period. Australian small caps have been downright abysmal.
Yeah, that's right. If you look back over the 14 years, or indeed if you even go right back to 1980 in the right-hand column and do the comparisons with the ASX 300 and the 200, you can see that the 300 lags the 200, and that's principally because stocks number 201 to 300 are in the 300 index, and they're also in the small ordinaries index, which has, of course, underperformed, as is clearly evident. The major reason for that, when we look back historically, is that when you consider the stocks from number 201 down, they are largely, or at least a good proportion of them, second and third and sometimes fourth tier mining stocks. Mining, of course, is very cyclical. From time to time, they'll show great prospects and share prices will rise. Companies will go into the ASX 300, but sometimes those mineral finds and the benefits that flow from them can be short-lived. And when that happens, those stocks don't do so well. Australia's small ordinaries as a whole over the last 45 years, which has been all of my career in financial advice, have definitely been an underperformer. Globally, that's not the trend, but there is no reason why Australia can't be that way. My personal view is that it's largely because of those second, third and fourth tier mining stocks that are incredibly volatile when it comes to consistency of performance and consistency of ongoing profitability.
Yeah, so we'll go off the reservation here, slightly away from the Solactive, just to highlight what you were saying there, Peter. And we've included the ASX 100, so you can see what's been occurring over the short term has also been occurring over the long term too, with small as you go further from 100, 200. So adding 100 additional stocks as we go down, then we get to the small ords, which again is 300 minus the top 100. And this is history. I'm not saying it can't turn around, but I did actually look, and there was only one sustained period where the small ords outperformed the 200 and the 300 over 10-year rolling periods, and that was October 2010 to May 2012. And apart from that, there was only one other 10-year winning period.
Yeah, when you look at the lagging of the small ords, it absolutely makes sense that the 100 has marginally beaten the 200 and has marginally beaten the 300. And it's simply the influence of the small odds becoming greater as you go from the top row to the second to the third. It's happened historically. That does not mean it has to continue to happen into the future. But as I indicated earlier, while ever our small odds has a significant component of second and third tier mining companies, there is a good chance that lagging will continue to be seen from time to time, if not regularly.
Growth of wealth back to Solactive, a win for Solactive over the ASX 300. And it's worth mentioning the bottom 100 stocks in the ASX 300 account for about 2.5% of the index.
The difference between these two outcomes is what I would just describe as noise. There's 9 cents difference, which is not very much when you compound it out. It's so inconsequential. I don't think you can take anything from this other than to say they're about the same.
And range of returns last 14 years. Kind of know what happened. Worst and best 1 years were always going to be COVID related, and I don't think there's too much more to glean out of that.
No, look, I think that whether it's the ASX 300 or the ASX 200 or the Solactive, 200 trying to enhance somewhat, at the end of the day, that's a market rate of return. It's not better, it's not worse. It's about right.
Rolling returns, not a lot of news either. Investors will be pretty familiar with this because it's all very recent.
Absolutely. And what this shows is that about 2/3 to 3/4 of the time returns are positive, 1/3 to 1/4 the returns are negative. That chart, albeit that the vertical disparities might be a little more or less than other indices, this is very much the same as any of the other major indices over that same period of time.
And largest fall in time recoveries in COVID. We're dealing with a very new index. Most people watching here probably experienced this and were able to ride through it.
Yeah, look, at the end of the day, being mostly larger cap stocks, especially when you consider the market weights, it did a little bit better than the broader indices through the COVID period. And, it's recovered relatively quickly. But again, the result is very similar to the broader market index anyway.
Risk return or efficient frontier, and over this time frame, it's probably say a B's appendage between Solactive 200, the ASX 200, ASX 300. As we can see, the small ordinaries way more volatile, lower performance, and exactly the place you don't want to be in the bottom right-hand corner.
Absolutely. It just shows that investors that want to trawl for what they think are bargains or opportunities down in the small odds over what is, a 14-year period have suffered significantly. And investors who've taken the broader indices, whether it be Solactive, the ASX 200 or the ASX 300, they've been well rewarded by the large, reliable, older, more sustainable businesses that make up those indices. And the rewards there, very, very obvious. To me, small odds is very much about taking a risk that will be rewarded from time to time, but frequently not rewarded.
And sources and descriptions of data. Thanks for your time.
Okay, thank you. Bye for now.